Welcome to a new video on the channel, where we analyze the most important trends in the global financial market. The dynamic chart you will see today is created based on the image shown on the screen, showcasing a fascinating comparison between the MSCI Asia Index and the Dollar Index, from January 2024 to January 2025. This chart not only reveals the behavior of two of the most relevant market indicators but also provides a clear perspective on how the strength of the dollar affects global investments. Before starting the comparison, let's review what the indices we are analyzing represent. The MSCI Asia measures the performance of equity markets in the Asia-Pacific region, including both developed and emerging economies. On the other hand, the Dollar Index tracks the value of the US dollar against a basket of major world currencies. This analysis allows us to observe how the strength of the dollar relates to the behavior of the Asian market. At the start of 2024, both the MSCI Asia and the Dollar Index showed an upward trend. This reflects a phase of optimism in Asian markets and also a consolidation of the dollar's strength. During these months, Asian economies benefited from growing demand, while the dollar maintained its role as a safe haven in a context of global uncertainty. However, this duality could not last long. As we will see, this parallel race began to diverge from April onwards, marking a story of highs and lows for both indicators. In April, the MSCI Asia experienced an abrupt drop. This setback was driven by a combination of factors: disappointing economic data in China, fears of a recession, and a slowdown in exports. Meanwhile, the dollar index remained stable, consolidating its strength thanks to the Federal Reserve's restrictive monetary policy. This was a key moment. The Asian market demonstrated its vulnerability, while the dollar continued to attract investors seeking stability. But the story did not end there. After the stumble in April, the MSCI Asia began an impressive recovery that culminated in July. During this period, the Asian index far outperformed the dollar index. This rise was driven by a series of stimulus policies in key economies such as China and Japan, along with a recovery in the technology and manufacturing sectors. On the other hand, the dollar showed relative weakness, allowing the Asian market to take the lead. Investors saw this stage as an opportunity to diversify and seek higher returns outside of dollar-denominated assets. During these months, there was also significant movement in capital flows. Many Asian economies began receiving increased foreign investment, especially in sectors such as technology and advanced manufacturing. This contrasted with the U.S. market, where the dollar, although still strong, did not show the same level of attractiveness for certain segments of global investors. Additionally, the rise of renewable energy technologies in Asia acted as a magnet for investments. Projects focused on solar and wind energy in countries like China and India created optimism among investors looking to capitalize on green technologies. The landscape changed again in August. The MSCI Asia faced a significant drop, dragged down by renewed economic concerns and geopolitical tensions in the region. This drop demonstrated how Asian markets remain susceptible to external events. Meanwhile, the dollar index began to recover. Investors sought refuge in the dollar, boosting its value and highlighting its position as a strong currency in the face of global uncertainty. One of the main triggers for this decline was the renewed uncertainty surrounding trade relations between China and the United States. Restrictive measures and trade sanctions weighed on Asia's growth prospects, while the dollar benefited from its role as a safe haven asset. At the same time, Asian markets were hit by a decline in consumer confidence, particularly in countries like Japan and South Korea. The uncertainty around global demand caused a slowdown in key industries like electronics and automobile manufacturing. In September, the MSCI Asia showed an impressive recovery, reaching new annual highs. This was due to positive economic data, improvements in exports, and renewed optimism around fiscal policies in the region. However, the dollar index also reached its yearly highs by the end of December. This rebound in the dollar reflected an increase in U.S. interest rates and continued demand for safe assets. This dollar strength posed significant challenges for emerging economies and investments in international markets. During this period, we also saw a significant shift in global investment flows. While Asian economies attracted speculative capital seeking to capitalize on short-term gains, the dollar solidified as the preferred asset for those seeking security in an uncertain global scenario. Despite the great potential offered by the Chinese market, we cannot ignore the inherent geopolitical risks. Tensions between China and other major economies, such as the United States, can generate volatility and affect investment stability. Additionally, government intervention in key sectors often introduces uncertainty, which could discourage some investors. However, it is undeniable that many of China's leading companies are trading at very attractive valuations. For those willing to take the risk, these valuations could represent unique entry opportunities, especially in sectors like technology, renewable energy, and mass consumption. Identifying the most resilient companies and adequately diversifying could be the key to capitalizing on these opportunities. It's worth noting that, despite the risks, China remains a global growth engine. Its ability to innovate and lead in sectors like artificial intelligence, clean energy, and advanced manufacturing continues to attract investors seeking long-term returns. The chart shows us the end of 2024 and the beginning of 2025, where the dollar remains the undisputed protagonist. While the MSCI Asia closes with a significant correction, the dollar index reaches its annual high, consolidating the narrative of a strong dollar dominating global markets. The strength of the dollar can be a villain for stock market investments, as it increases the cost of dollar-denominated debt and affects the competitiveness of emerging economies. Additionally, a strong dollar reduces the international earnings of U.S. companies when they repatriate income generated in other currencies, impacting their performance in stock markets. This can also discourage global investors from diversifying into U.S. stocks, increasing pressure on the market. However, it also opens opportunities for those seeking refuge in safe assets. It's important to emphasize that a strong dollar often correlates with tighter global financial conditions. This means that not only do emerging markets face headwinds, but global liquidity also shrinks, which can exacerbate downturns in equity markets. This chart not only shows the volatility of markets but also how the strength of the dollar can dictate the course of global investments. Asian economies have great potential, but the dollar's influence remains a decisive factor. As investors, it's crucial to balance risks and opportunities. The key is to diversify, stay informed, and look for strategic entry points that allow us to capitalize on emerging trends. Thank you for joining us in this analysis. Don't forget to like, subscribe to the channel, and activate the notification bell to stay updated with our videos. Finally, if you're interested in knowing what could be a better investment in 2025, commodities or stocks, we invite you to watch our next video where we explore this question in depth. Don't miss it.